This computer. Okay. Perfect. All right, everybody, welcome to our Thursday 6 p.m. call. It is our Beyond Inner Growth Network weekly call. This week we have a special guest on the line with us, Stacy Camry. Stacy and I met in Charlotte when I started doing business in Charlotte. I was working with a team, onboarding systems, support, all of that good stuff. And we met. She was their preferred lender for the team. So since I was a part of the team, I was like, all right, she's gonna be my preferred lender as well. So I had to get to know her a little bit. I finished my consulting time with that team, went on about my business, and maybe a month later or so, maybe a couple months, I don't remember the timeline. But when I stopped working with the team, I got a client. And I was like, oh, what do I do? So I called Stacy. Stacy got her pre-approved. And I did my very first deal in North Carolina, Charlotte, North Carolina, with Stacy. So she is forever in my heart because she helped me get my business started in Charlotte. And I'm trying to do another deal. So I'm on her email list. She keeps me
Oh
on
yeah.
that email list. And the last email that caught my eye was about self-employment. Because first of all, we as real estate agents are self-employed. I work with tons of real estate agents, so I wanted them to get the information. But we also have a pool of potential buyers that come to us as self-employed individuals. So I was like, oh, we got to spread the information. So I asked Stacy to come to our weekly call. So, first of all, let me thank you for taking your Thursday evening with us. Mind you, she had an open house because her daughters get ready to go back to school, but she chose to spend it with us tonight. And again, I'm very appreciative for you. You are always pulling through for me, always pulling through for my team, my network, asking me who's in my network, who needs help. And she's always volunteering to come and talk to us and help us with anything we need help with. So I thank you, Stacy. Stacy is with Town Bank Mortgage. She's going to tell us all the states she is licensed in. So that way, when someone is watching this on YouTube after today, they will know that they can also contact you to work with you as well. So go ahead and take it over, Stacy. I'm here. I will be controlling the buttons on my side. If you call on me, I will talk. If not, I'll be quiet.
Okay. Can everybody
All
hear
right,
me? Okay.
we can.
All right. So, a little bit about my background. So, I've been doing this over 30 years. I'm not going to tell you how long over 30. Over 30 is all you need to know that I've been doing this a long time. Um, I was president of the North Carolina Association of Mortgage Professionals in '08 and '09, about right before the mortgage implosion. So, it was kind of like being captain of the Titanic at the time. But we did weather the storm. We are back. And a lot of the programs we're going to talk about today came about after the meltdown. So, and I can tell you why that happened. So, the government stepped in. They felt like lending had reached an irresponsible level, and I would tend to agree. We went from doing stated incomes to no income verification to no doc at all, and it just was a little bit loosey goosey and crazy. So the government stepped in and said, you now must have the ability to repay, but depending on how you derive your income, ability to repay can mean different things to different people. So let me share my screen and we will get started. I hope I do this right.
No, we saw it already. You were already sharing. So go
Oh, I
back and
was?
share again. Uh-huh.
Uh-oh.
Go back. Yeah, there you go. Okay, now
Is
we
that
see it. Yeah,
it?
yeah.
Okay. So, in talking to Nakia and helping her try to help her build her business stronger here in the Carolinas, just to back up and say which states we cover 17 states right now, which is basically everything on the eastern seaboard, and Colorado. So it's kind of odd that we just kind of reach out to Colorado that's not connected to any of the other states, but New York, Connecticut, Maryland, Virginia, North Carolina, South Carolina, Georgia, Florida, Tennessee. So lots of them, 17 states. So if you're interested, call me. If we don't cover it right now, we can. We just did a loan in Indiana that we didn't do that. I think we're going to add that as a state. So, that we do mortgage business in. So banking business is Virginia and North Carolina and looking to expand to South Carolina. So, but just to talk about alternative lending solutions, because just because somebody's paid a different way instead of W-2 or salary, doesn't mean they shouldn't be able to have a loan. So I think everybody deserves a loan, and we're here to give it to them. So, like I said, the non-QM, why is it not moving? Oh, shoot.
Maybe click on the side over there where
I
your
can just scroll
small
through it.
ones are, and then yeah, there
Yeah.
we go. We see agenda now.
So yeah, so non-QM is anything alternative income stream. So specifically, it helps for self-employed borrowers, for high net worth borrowers, because I'm sure you've had plenty of people say, I could pay cash for this home 10 times over. I just don't want to. Well, that's great, but we need to show that as a way to prove steady income. So solutions for high net worth borrowers figures in for that. And then solutions for investors, because a lot of people in this day and age are realizing that the stock market may not be where it's at. So they want to invest in real estate for wealth building, and we want to support that 100%. So non-QM characteristics are anything with expanded debt ratio, so anything over 50% debt ratio, anything with an interest-only payment option. So we do a 40-year term and a 30-year term, all with interest-only payment options. No private mortgage insurance. Private mortgage insurance allows for anything with less than 20% down, and that private mortgage insurance insures the lender in case the borrower or the buyer defaults on that loan. So these loans are self-insured, which makes the interest rates slightly higher, but when you figure there's no mortgage insurance, then it really kind of evens out a little bit. Alternative income sources is really the mainstay behind what this is all about, and that there's self-employed project managers, contract workers, commissioned employees that may have a tough time matching what the full doc guidelines are. So this non-QM just applies to the people that fall outside the box. So, and then manual underwriting. Most of these require manual underwrite. There's not some DU or LP findings that give us an automatic approval on these. But for the lender that knows what they're doing, manual underwriting should not be a problem. So, all right. So non-QM market, I'm not going to go into this heavily. This is mainly for when I'm explaining this to other lenders. But this just shows non-QM originations and how we expect that to grow between 2023, 2024, and 2025. Other things remaining kind of the same, but we expect this type of income qualification to be more and more prevalent and growing in that market. So if you want to target self-employed borrowers, we've got dual marketing, co-branded marketing that we can share with you, that we can help you drive that business to your portfolio. So one of the most popular programs is the bank statement program. And I can't see if you have questions. So Nakia, just unmute yourself if somebody's got a bunch of questions or something. But otherwise we can answer questions at the end. But
okay.
So bank statement program is ideal for self-employed borrowers and small business owners. This program, we look, it's got to be somebody who's been self-employed for 2 years, just like a full doc situation. But we look at either 12 or 24 months bank statements, and we look at either personal or business, depending on.
We lost you, Stacy.
I
Can
was
you
about
hear
to say,
me?
did she go out?
Where the
Yeah.
deposits mainly go.
Oh, that's right.
She's
Categorical
saying that.
no, it's a maybe, because perhaps they were, what happened?
You went out for a
Can you hear me
moment.
still?
Yeah, we
Okay.
can hear you now. It went off for 1 second, but keep talking.
Okay, sorry. So bank statement programs, they need to be self-employed for 2 years. If it's been less than 2 years, but they've been in the same line of work, we can potentially work with that. So the good thing about these programs is they like to grant exceptions to the rule if we've got a reason to do so. So if we've got compensating factors like extra reserves, things like that, high credit scores, then the greater chance we have of getting an exception on some of this stuff. But the features of this program, first of all, of most of these programs, no tax returns needed, because the thing with self-employed borrowers, of course, they're going to take every write-off they can, because why not? Because they're allowable. And that's less they have to pay in taxes. But with full doc, you can only use their net income that they're paying taxes on to qualify them, when we know that there's really probably more income actually there that they have available to them. So that's what these programs are meant to find, the happy medium between the net and the gross income. So with this, we take 12 or 24 months personal or business bank statements, depending on where the income is deposited. When we calculate the income for you, when we're doing a pre-approval, it generally takes place usually within 24 hours, but for sure within 48 hours. But we go up to 90% loan to value with no mortgage insurance, 620 credit score. We do single family homes. We do townhomes, modular homes, condos, and non-warrantable condos. That's a whole nother topic we can cover at another time. If you guys do a lot of condos, we can talk about what makes it warrantable and non-warrantable and how that changes the marketability and the rates and the program features, but whole nother story. Owner-occupied second homes and investment properties for this bank statement program, and loan amounts anywhere from $100,000 to $3.5 million. If someone, so consider this, we're not looking at their tax return, so we're not seeing their rental income on Schedule E. So if they have rental income in addition to their normal self-employed income, we can potentially use that income as well in addition to what we see as deposits going into their business bank statements or personal bank statements, as long as the rent goes into a separate account. So a lot of times they may run their business through their business account, but run their rental income through their personal account. And in that situation, we could use both. So just an option in case we need to have additional income. Any questions so far?
Not so far. We're hearing a lot of good information. So we may have questions at the end. Thanks.
Okay. All right. For the rental income, we take 75% of the lease amount just because we figure that 25% goes to maintenance and upkeep typically. So that's what that's all about. The next program besides the bank statement program, so this is 1099 and year-to-date bank statement feature. So this is ideal for your Schedule C borrowers. So this is commissioned employees like me and you. This is project managers who deal on a 1099. This is your landscaper. This is your house cleaners. This is anybody that does deposits and gets paid on a 1099 through a certain company. So if it was a house cleaner that cleans for a certain business, instead of, all the different houses individually or landscaper individually would be more the bank statement program. But this is if somebody gets, paid majority from one or two businesses and they get paid by 1099. So with this one, no IRS tax returns. So that echoes the same as the other program. We take a 1099 plus their year-to-date bank statement. So if we were in March, we take the first 3 months bank statements and their last 2 years 1099s and average them. If we're 10 months in, we'll take 10 months and the last 2 years 1099s and average them. So you and I know that on our 1099, we may write off mileage, we may write off meals and entertainment, we may write off CE, all those things. This one takes straight off the 1099 before any write-offs. So it's very nice. Up to 90% with no private mortgage insurance. Loan amounts $100,000 to $3.5 million. Again, same 620 minimum credit score, same property types, and also works for owner-occupied second homes and investment properties. That has become more popular than the bank statement program because the bank statement program can be sort of convoluted with cash deposits or ACH transfers and things like that. The 1099 is just pretty straight up. So it's one of my favorite programs. So just something to think about. This is just how we derive it. We take the 1099 plus the year-to-date bank statement divided by the number of months that we're averaging over. So this is the profit and loss program, the 1 year profit and loss. This is the one that Nakia did an awesome video or reel, depending on where you're watching it on, if it's on her YouTube channel or TikTok. She sent it to me on text, so I'm not sure where it got posted, but it was awesome. I hope to be as natural as she is in front of the camera one day, but I'm still obviously working on that. So this program is for self-employed borrowers. And we need a 1 year profit and loss statement that is prepared by their CPA or an enrolled agent for the IRS. So we don't live in California. I don't know if there's anybody on here from California, but that's something special they have in California. But again, no IRS tax documents needed. This one goes up to 80% loan to value instead of 90. Still owner-occupied second homes and investment properties. This one, a little bit higher minimum credit score because it's a little riskier. Same property types, same loan amounts, 100,000 to 3.5 million. 1 year profit and loss prepared by the professional. And with that, we don't get the tax return, so it doesn't need to match the tax returns. So a lot of times when a self-employed borrower takes their year-to-date P&L to the CPA, they're saying, you know, what write-offs should we take? What additional write-offs can I take? What did you write off for me last year? Those kind of things. But the profit and loss can then be edited and certified by the CPA. So we can use just the P&L and not the actual tax returns, which may have additional write-offs on it. So that is a great program to use as well. I don't know if who this applies to in this state, but in North Carolina, we had an extension because of Hurricane Helene until end of September to file taxes for 2024. So we are hitting CPAs and tax professionals with all these programs right now, saying if you're getting ready to write off a bunch of stuff, but you don't want to, or you're afraid to because you know that your client wants to buy a home this year or next year. So we're trying to get a hold of them before they don't take as many write-offs, so that we can say, you know what, go ahead and take them all. We've got alternative programs for you to use for those folks. So a good time normally to invest in hitting on talking to different CPAs and things like that would be first quarter prior to April when normal tax filings happen. So something to think about when you're figuring out your marketing strategy of where business is coming from. All right, so asset utilization. This is for your high net worth borrowers. This is for folks that say, I have, $3 million in the bank. Why won't they lend me money on a $300,000 house? And the answer for the underwriter is, well, then pay your cash and don't use us and you don't have to worry about it. But we don't want that to happen. We want them to use a mortgage and not use their assets, keep those assets invested where it's earning them money. So hopefully more money than what the interest rate is costing, even at 7 or 6.5%, kind of where we are right now. But as rates come down, surely their investments are earning them more than what their mortgage interest rate will. So with that, we are looking at different types of assets. So if it's liquid funds like checking, savings, money market accounts, we can use 100% of that. If it's assets in a trust that's totally accessible and liquid, we can use 100% of that. If it's money that's in the stock market, we take 70% of the value of the stocks because we have to consider that stocks move up and down all day, every day. So the value of today may not be the value of tomorrow. So we just take 30% cut on that just to be on the safe side, to be conservative. And then retirement assets, if they're not a retirement age, we take 60 to 70% of that. Also figuring in what could happen if those retirement accounts are invested in the stock market. So, but that 660 score, just like the P&L program. The benefit of this is they don't have to actually liquidate the funds. We just use the funds that are sitting there invested. We don't ask them to change anything about it. We just look at the statements and figure out how much of that we could use if they had to. And we take it over the term of the loan. Conforming has this option also, but it's not as expansive as our non-QM function on this. For example, on conforming options, it only applies to owner occupied and second homes, whereas this applies to investment properties as well. And usually conforming is only looking at liquid assets, whereas this one looks at liquid and non-liquid assets. Loan amounts from 100,000 to 3.5 million, and same property types. If you work with any financial planners, if financial planners send you business, they love this program because they don't want their clients cashing in investments. They want the investments to stay where they are, but still be able to use that to the advantage when buying a home for their client. And the last one, if there's no other questions so far, the last one is a fun one that I like a lot. And for some reason, a lot of people are afraid of this loan. I'm definitely not afraid of this loan. And there are other loan officers that send me business on this loan that either don't get it or just don't understand it. But it's great for, I've done a lot of realtors' personal loans on this. because you guys are on the forefront of seeing when there's a bargain out there and when there's a deal out there, and you believe more than anybody in building wealth in real estate. So this is specifically for people that want to invest in real estate, and it's a great program for that. So it's called the DSCR, which is the debt service coverage ratio loan. So with this, the biggest problem with this is it has to be investment property. Can't be a second home. Can't be something that is investment property part of the year and you live in it part of the year, or second home part of the year. It needs to be full-on investment property always. And the way that we calculate debt service coverage ratio is, and I call this the house speaks for itself. So as long as the rental income per the appraisal or per lease is at or above whatever the total house payment is, so principal and interest, taxes, insurance, and any HOA dues, any association dues, as long as that is at or above what the payment is, we're good to go. We don't look at tax returns. We don't look at bank statements. We don't look at any of that. If it's less than 1%, so for example, if the income was $750 a month and their payment's $1,000, that doesn't work. That gives us a 0.75. So it's got to be at 1,000 or higher, or not 1,000, at 1% or higher. So for example, if you got $1,250 in income versus 1,000 in payment, that would be a 1.25. That would be great. So 1 is the minimum, and anything above that is even better. And the way we calculate that, if there's an executed lease, we'll use the lesser of the lease agreement or the market rents from what the appraiser gives us. So he'll do a comparable rent schedule on the appraisal, which tells us what market rents are. And typically in this day and time, I know there's a lot of Airbnbs out there and short-term rental stuff going on. It is very difficult for an appraiser to calculate that and find that information. So it's pretty quick and easy for them to look at long-term rentals. So that's basically what the appraised value is going to say. If the executed lease agreement, this is just an exception that I've had, if it reflects a higher monthly rent than what the appraisal says, as long as they've received 3 months worth of rent, we're good to go on that. So I had one here in Charlotte in a gated area, and they were renting it through corporate America, and it was rented fully furnished. So it was rented for much more than what the market rents were for an average house of that size. But because it came with all these different amenities, and they let them, a car came with the lease and things like that. So we were able to show 4 months of receipt, and you can't do 3 at one time. It's got to be 3 consecutive months. So we had 4 consecutive months at about double what the market rents were per the appraisal. And we were able to use that as income, which saved the day. So minimum credit score 660, no personal income used to qualify, no bank statements, no 1099s, no tax returns. Like I said, the house speaks for itself. So as long as the house will generate enough income to cover that monthly payment, we're good to go. 80% loan to value. Gift funds are allowed if it's a purchase. They are not allowed for reserves, but just for down payment. Loan amounts from $100,000 to $2.5 million. Generally the same town hall. That should be townhome. Sorry. I'll fix that. Generally the same type properties, investment properties only, no second homes that can be rented out. It's got to be investment property only. And then this is rare for a lot of programs out there. People who do offer this program, they say you have to have an investor history of at least a year. Most programs do say that, but I have gotten an exception for first-time investors. It's just at a more skin in the game. So like 70% loan to value instead of 80%. So again, that's on an exception basis, but we've gotten it. So this program allows for exceptions more than any other program I've seen. So these non-QM programs. And that is the end. So with that, you guys are the key in making this work, because I feel like home buyers believe what the media says, and the media doesn't promote any of these programs. They don't talk about these programs. A lot of lenders don't promote these programs because they don't want to use them. They don't want to learn something new, or they're scared of them. I embrace it. I embrace all buyers of all types, and I want to use all types of income and put more people in more homes. So whether it's investment home or primary residence or second home. So if you are empowered with this knowledge, then I feel like you can get business from it, from other realtors that are not pursuing this. or just by telling your clients that you have, you too can get a loan. It doesn't matter that you're self-employed. It doesn't matter how many write-offs you have. There are alternatives for you, and we are happy to help with that. So there's my contact info. I'd love to work with each and every one of you. So Lending with Stacy is my website, and we can look at doing a soft pull to get started for folks that are afraid of having their credit pulled. We also have a credit team that will analyze their credit if there's something that they didn't know about. Number one, we find that 50% or 45%, I think is a stat right now, of credit reports have inaccuracies that can be corrected. And we're not talking about just writing in dispute letters to try to erase lates that were really late. We're talking about affecting what affects the other 65% that affects the credit score that we can help, because you can't really fix a late. If you're doing your due diligence and you're doing it the right way, responsible lending, you can't just go erase lates for 30 days and buy a house real quick and hope that it sticks. We want to do effective change, and that's what our credit team looks at. So to get them ready to buy and get their credit score up overall that will stay and last. So that's an option too. So that sometimes is a barrier for people talking to a lender, is the pull of credit. But we can start with a soft pull and go from there. So
All
let me
right,
know.
thank you, thank you, thank you, thank you. So, questions. Jaquila said this was awesome.
Yeah.
She's right here in the Charlotte area. Maybe when we're meeting in person, I'll see if she's available
Yeah.
to meet also. Raven said awesome. Crystal agrees as well. Crystal's in the Charlotte. We got to get you in the Charlotte area to have lunch or something with us.
Well, and we've
We'll
got
meet with
three
you.
branches. We got one in Myers Park off Providence Road. We got one
Okay.
in South Park in front of the big green pond over there near the
Uh-huh.
park behind the mall. And then we got one in Ballantyne, and all of those have
Okay.
big, beautiful boardrooms just waiting for us to have meetings that we can have people in person and Zoom into, and we can do
Okay.
refreshments, provide all of that for you guys that want to meet in person. So,
Okay. Well, we're gonna get you on the schedule.
yeah.
September, October. All right, we'll get us over there to seeing you. Anybody have any questions? I like that DSCR loan. Is that my brain? I've keep hearing it, but I've never seen it broken down like that. So we may want a copy of your slides too. Because if we get a copy of your slides, then we can do some videos.
Okay.
Yeah,
I got to get the
yeah.
blessing from compliance on this because I whipped this together,
Oh.
and
Oh, well,
but
we just want
I've
the
already submitted it to
information.
come
We're
out
gonna make
training.
our
Yeah.
own. We're gonna make our
Yeah.
own videos, but we just need the information. Or even if it's on a
Yeah.
website, if we have it laid out, then we can pull it. Like I pulled from your email. I took your email and I put it in ChatGPT and I told ChatGPT to write me a script to make me a video.
Well, it did a great job because it sounded very natural for you. But
Oh, well,
I can
thank
tell
you.
you that our marketing department is working on co-branded flyers and
Okay.
postcards. So one thing, if you can get a client list from your CPA that does your taxes and you show
Hmm.
them why, I don't think I can show you.
Oh, yeah.
I'll send you a copy of some postcards, Nakia, with me and you on there as co-branded that
Okay.
show you what the postcard looks like. But if you're co-marketing with us, you get access to all this stuff on your own without going through me, or you can work with me and I'll show you the different
Hmm.
ways to use it. And we have a total expert training that show you how to access this. But if you log into there, it will split the cost of the
Okay.
mailer for both
Oh,
of us. So a
yeah.
normal postcard only costs you 30 cents. So if you want to go to your CPA and say, here's what I'm trying to do, let's get more of your clients investing in real estate, and then they'll have more money and more things for you to write off on their tax returns on their Schedule E. And then just if he or she will share their client list,
Mm-hmm.
we can do mailers to all those clients. So
Okay, that's good. Yeah, you had mentioned that before, and I apologize. You mentioned
yeah,
that before, and we got to get these agents on your total expert because if y'all
yeah,
heard her correctly, yes, she will split the cost of marketing if you're sending out postcards or printing and it's co-branded material. So you guys should definitely take her contact information, contact her, maybe set up a one-on-one Zoom call and talk more about that. Because I know I heard a few people, like maybe even Geraldine, ask about marketing and mailers and all that good stuff. So here's your partner for that, Geraldine. I finally found her for you. She will co-brand and co-market and co-mail and all of that stuff with you. So
Oh,
you don't you have a partner in your marketing efforts. Raven is asking about HELOC. HELOC. You have some HELOC programs, I'm sure.
we do. The HELOC programs are generally going to be in the bank footprint states, so
Okay.
Virginia and North Carolina.
Okay.
But I can research and see if we can find an investor for states outside of North
Okay.
Carolina and Virginia.
Okay. Yeah. Raven is in Maryland. Yeah. And Town
Okay.
Bank. Okay. I guess not. Town Bank. Yeah. Town Bank is not. Town Bank is only a mortgage in
Yeah.
Maryland, I think. Okay. Okay. Essence says with the DSR, that DSCR loan, could the home be a fixer upper or multifamily?
So I don't think it can be. Let me look back real quick.
Hmm.
I know it can't be a fixer upper. It's got to be inhabitable like it is. It's got to be in good
Right. Yeah.
condition. I'm in ready to rent right now.
Hmm.
But 1 to 4 unit, yes,
Yeah.
multifamily we can
Hmm.
do.
Yeah. And I see 5 to 9 units too. Did you see
Hmm.
that?
Hmm.
Yeah. So multifamily, yes, Essence, not a fixer upper. Fixer upper, there is a loan for that. Which
We
then
do
that's
have
a
a
good
rental
question.
line,
There you go. Which loan works best for the fixer upper? I was leading into that.
and we do have rental loans that allow you to for investment properties. So we're
Mhm.
people typically offer them on primary and second homes, but we actually include investment properties as well, and it allows you to finance in 6 months worth of payments while you're waiting to fix it
Okay.
up to get it ready to rent. So
That's good. And then I want to go back one more time because I just want to say this is what I was thinking, but I want you to confirm if I'm true or not. And if you could turn back maybe two more slides, the 1099 loan is 80% loan to value. However, or one, yeah, 1099.
it's a 90.
Yeah, not
Yep.
90%. Okay. 1099 plus year-to-date bank say, okay, no, go to the next one. So it's the profit and loss statement is the
Hmm.
least amount of
That one's 80.
paperwork that somebody needs, but they got to put down 20%.
The only issue with this one is because it's
Mhm.
got to be third party tax professional. It depends on what they'll charge you to have an audited P&L. So for them to
Okay.
check it, to put their name
Okay.
on it. So, but it just depends on your
Okay.
person. So, a business versus a personal and situation, what kind of income you have,
Hmm.
what kind of self employment you have. But that's between you and your tax professional. But
Oh,
that's
yeah.
the only time I've heard somebody complain about that. It was because of that, and we just rerouted to a bank statement program. So.
Okay, okay, yeah, because if you can do this one, then you can be almost probably do the other ones. But I
Mhm.
like these no tax returns. Oh my goodness, because we are writing off so much stuff. I mean, I'm looking at it for myself now. I'm thinking that here's an opportunity because I'm sitting there waiting for year after year after year to have a good year to go and apply. And now it sounds like I really don't have to wait year after year after
Right.
year anymore.
Right.
I
That's
can
right.
literally, yeah, literally buy me a house or even that DICR loan. So maybe that's the
Yeah.
one. Go back to that one because I'm like, well, wait, oh no, no, because that has to
That's
be an
going to be
investment
investment property.
property.
You want to live in
But
it. Yeah.
I can buy me an investment property. Listen,
Yeah.
while I'm waiting,
That's a
make
current
me some
earn your
money.
extra income to buy a bigger property.
Yeah, right. Because I've been waiting to buy another investment property too. I'm slow on investment properties now, just because of all the other stuff. So now I think that's what I was thinking about. The DSCR, I could literally do an investment property
Hmm.
with. And literally, yeah, I got a plan for that. I'm gonna be talking to you. I
Yes.
got a real good plan for that.
And
Hmm.
then, just think about all the CPAs, all the financial planners that you
Hmm.
know in your sphere of influence. I mean, that they'll send you the business if you let them know how to make their clients happier because their
Yes.
clients are probably going through the same thing that you're talking about, Nakia, of I want to buy a house, but I know I'm going to have to pay more taxes. So let's wait till next year, or let's wait till the
Yeah.
next year, or let's go
Can we?
back and redo taxes from last year and pay more money. But, now they
Yeah.
don't have.
All right, so Tawanda has another good question. DSCR. So when you're buying a DSCR loan, most time when we buy investments, we say 2311 Edmondson LLC. Can
Yes,
the investment property be in the business name or does it have to be in your name? Can do
in
LLC?
the business name. Yep,
Oh, that's even better. Look at that,
yep.
Tawanda. So we gotta make a list of all our investors and make some phone calls.
That's right.
Okay, okay, I'm ready. I'm ready now.
All
You got me
right.
thinking I got homework for the next couple of weeks. Phone
Yeah, and
calls,
especially
follow-up
now.
calls.
I mean, think
Right.
about in North Carolina, we're in Charlotte, so it's I think it's
hmm
and I forget. I mean, my house, thank goodness, was not affected. I have friends in Asheville that were severely affected by Hurricane
Yeah.
Helene and will be for the next 10 years. But for some reason, FEMA gave us all the way to past Charlotte, I think to Monroe, even and maybe even further to have that same allowance. So a lot of CPAs are just now because I haven't found my taxes yet, but I will be in the
Okay.
next 30 days. But this is when it's happening. People that come to the to crunch time.
Okay.
So those people need to, those
Mm.
tax professionals need to know that go ahead and write it all off because
hmm
we got other programs for you.
Okay. So there's a reel right there. Have you been writing off everything on your taxes but still want to buy a house? All right, so we're gonna have to figure out that when I gotta get my partner
Yep.
Jaquila and so we can go make some videos. Get my camera partner. Essence. Essence is really good with the reels and the shorts and the TikToks. Essence. So I need her to lead the conversation, be our video director, along with your Essence and your marketing director. Oh my
Yep.
goodness.
Dana. We'll get Dana involved.
We'll be
Yeah.
cooking with Crisco. All right, so we got to set up a meetup to record some content.
Yeah.
All
Let's do it.
right. Okay. All right, everybody. Any more questions before we let Stacy go again? Stacy, thank you, thank you, thank you. You helped me do
Absolutely.
my first loan. It will not be the last one that we do. I am searching every single day trying to get us a client. All right.
I love it. I'm here for you. Let me know.
Thanks so much. Anybody else going once? Going twice? All right. Well, we are let me hit stop recording.